Okay, why don't we get started? Hello and welcome everyone to RedeConnect 2026. I'm Scott Church, a senior partner here at Rede, and very happy to once again this year be kicking off our keynote webinar, The Rede View. This is our opportunity to take advantage of the unique position we have in the market and use it to describe some of the trends we're seeing, make sense of them, and suggest where they may take us in the future. Our views are based on our proprietary research, such as the Rede Liquidity Index, or RLI, published twice a year, as well as recent white papers and analysis of our internal data. Plus, of course, a good pinch of anecdotal experience raising capital for our clients in these not so straightforward markets. This year, being a Winter Olympic year and our fifth iteration of RedeConnect, we're pleased to have achieved record registrations for the event with well over 1,000 of you signed up. Thank you. We also want to really give it our all in terms of producing and sharing proprietary content with 7 webinars, including this one. We've got a packed schedule over the next few days. In addition to the webinars, we've got 89 small group virtual roundtables for LPs to meet with 33 of our exceptional GP clients. That adds up to 1,061 LP GP meeting seats allocated. So it does feel like RedeConnect has earned its place here in its 5th iteration as a highly anticipated industry event, and we're so glad that you could join us today and over the next 2 days. Now, for this segment, in addition to myself, you'll be hearing from Adam Turtle, our CEO, Alex Bazarewski, a partner leading our coverage team in America's business, Ian Flavel, a partner who leads our advisory practice for the Americas, and Gabby Joseph, who heads up client development here at Rede and also leads on our proprietary research and insights. A quick word about what's in store for the rest of RedeConnect this year. As mentioned, we have 6 other webinars besides this one, today and coming up tomorrow and Thursday. And as you can see, we've managed to line up a formidable array of industry thought leaders. Just earlier today, my partner Charles Wan led a panel of experts from the Asia-Pacific region in a discussion of winning strategies in a complex landscape. If you missed that, you'll be able to access a recording through our website. Following our segment today, Nikki Ruklich will host a webinar on sustainable franchise building. We brought Nikki on board last year to lead our new strategic advisory services practice, which is focused on this area. We get a lot of questions on where we're finding new growing pools of capital from LPs, as you can imagine. So to address that, I'm very excited to be leading a panel on global capital flows tomorrow with a number of my coverage team colleagues. Then on to Wednesday, my colleague Etienne will be revealing the findings from our latest climate and impact white paper. He'll be joined by a panel of experts to discuss the results and deliberate on where the puck is going in this area that has had a lot of questions asked of it in the last 12 months. While on Thursday, my colleague Magnus Goodlad will discuss succession management, a view from the front line with Emily Taylor of Russell Reynolds. And finally, Charlie Savinar will lead a discussion on what it takes to build a modern credit manager with an impressive lineup of leading credit GPs. Well, I wanted to point out that we celebrated 15 years in business just a couple weeks ago. It's hard to believe it's been that long since Adam and I hatched a plan for a new fundraising advisory firm in the pubs of East London. We're especially proud of the team and culture we've built over these years and the many outstanding clients we've had the privilege to serve. And we want to thank all of you, our industry friends, clients, colleagues, and peers who have supported us along the way. Thank you. Now, it would be remiss of us not to mention some of our highlights here at Rede over the past year. Starting with the team, our total number of professionals worldwide has grown to just over 160 across our 6 global offices, the 2 most recent openings being Los Angeles and Dubai last year. We're also super excited to have launched our new Strategic Advisory Services, or SAS, business line I mentioned previously, led by Nikki, to help private market GPs formulate and achieve their growth strategies and enhance franchise value. As an indication of the depth of data and information we garner in our investor coverage effort, we generated over 33,000 unique LP call notes last year, a new record for Rede. We held 15 final closes, including 5 one-and-dones, which is pretty remarkable considering the continued challenging primary market conditions last year. Our capital solutions or secondaries team closed on 11 GP-led transactions, while on the primary side, we closed on 30 billion euros, including just over 8 billion from new investors into our clients' funds. Just before we dive into the presentation, some housekeeping. We do want to make this interactive and take your questions. So we'll reserve some time at the end for that. Please do send those questions in using the chat function on your Zoom. Our plan today is to try to keep our presentation to about an hour and then have 10 to 15 minutes for Q&A following. Finally, just to remind you, this session is being recorded. So if you have to drop, you will be able to access the full recording later at your convenience. So let me now turn it over to Adam to kick off some observations of where we are in terms of market sentiment. Adam?
Thank you very much, Scott. So where are we? Well, it's February already, so it's actually easy to forget that 2025 was quite a year. As you can see on the chart, LPs came into the year relatively optimistic. That's the 60 number in the left in the box. Putting aside the politics of it all, the new US administration was expected to herald business-friendly policies that were expected to be, well, good for business. As it turned out, it wasn't quite as simple as that, as I think we can all remember. It was a tumultuous year, one where you were never quite sure what the next day, let alone the next month, would have in store. And that, of course, has an impact on investor appetite, which we saw change during the year. The RLI, which Scott mentioned earlier, fell to negative territory, as investors were cautious about deploying as they were adjusting to an ever-changing world. The result, well, once again, the extraordinary predictive powers of the RLI proved themselves out and has been globally reported. Overall capital raised fell 11% last year versus the prior year. But where are we now? Well, again, as you can see on the chart, number 57, we enter 26 in broadly the same place we entered 25, at least from an overall sentiment perspective. Much like then, on the back of a relatively rough year, investors are broadly optimistic about go-forward deployment, expecting to grow allocations year on year. It's certainly nothing like the heady days of 2019 or 2021, but it's growth nonetheless. So is this indeed, as the title suggests, Groundhog Day? Well, if we consider some of the high-level currents that are affecting the industry, I'd say yes and no. Let's start with what is similar. Well, if we start at the bottom left, much like coming into 25, the good news is that, the last couple of weeks aside, public markets remain robust. So there's no particular denominator effect to speak about. LPs are generally not over-allocated, and we are, as the year starts, having lots of conversations about investors' plans for the year ahead. And more often than not, that is not sitting on their hands. They're thinking hard about what they're going to do. That's a good start. On the flip side, a year on, geopolitical tension remains a fact of life. Continuing wars, the threat of conflict, is the sad backdrop to the world that we all live in, and it doesn't seem to be changing anytime soon. And on the portfolio front, also like before, the reality of exits over the last 12 months has been muted and somewhat disappointing. However, hope springs eternal, and hope for the exits coming into 2026 is higher, as reflected in this chart. Or put another way, surely the buses must arrive at some point, right? So what is different? Well, a year in politics is a long time, and I don't think it is hyperbolic to say that we're operating in a new world order from that which we entered last year. The historical orthodoxies that form the basis of our worldview have been shaken on trade, on international relations, and on our expectations for the future. This creates new risks, challenges, and opportunities that reflect a clear break with the past that we're all adjusting to. On exits, as I said, the expectation here is strong, but it has perhaps been tinged with a dose of realism. Investors are expecting money back, but they are not expecting miracles. Rather, they're adjusting to the realities of a tougher macro following a period of high valuations in the COVID years that has ultimately led to a return erosion in those vintages. And finally, a few years into the impact of AI, we're starting to see its real impact on investment behavior. The potential is, of course, extraordinary, but the realization that there will be both winners and losers is truly starting to dawn. The great challenge for LPs and GPs in this environment will be to ensure they're on the right side rather than the wrong side of that coin. So in summary, a lot to contend with when it comes to capital deployment. What does this mean for investment preferences at a high level? Sectorally, in many ways, it's not a huge change. Healthcare and technology still leading the way. However, it is worth noting that this survey data was taken before the public market sell-off of the last couple of weeks. And anecdotally, we are already starting to see people rethink their technology allocation somewhat. I think this will be an evolving story of 2026. What is noticeable in terms of change, however, is the dramatic rise in interest in aerospace and defense-related segments, which I would note against the softening of interest in strategies related to sustainability and impact. I think this shift reflects the global narrative I described on the prior page, where concerns around the dramatic changes in the global world order are, for now at least, trumping people's investment preferences over other societal concerns. These themes are further reflected when we ask LPs what they're concerned about. What monsters are keeping them up at night? The watchers, the avid watchers of the review, of which I'm sure you all are, would notice the relative incidence of more risk-oriented worries higher up on the list of concerns versus what I would call pro-cyclical worries, such as fund scaling or getting access to the best managers. As you will see, not surprisingly, DPI, more than anything, is top of investors' minds. No surprise. However, beyond that, macro challenges and geopolitical risks are high on the agenda. On the flip side, LPs are noticeably less concerned about securing capital for their program, again, a reflection of the denominator point I made on the prior slides. This is good news. There is liquidity. The question, of course, is where is it going? Which is a nice segue into our 7 observations about the state of the market in 2026. We'll discuss each of these points in more detail in the sections ahead, so I won't belabor them now, but quickly. Firstly, will it be fast or slow? When it comes to fundraising speed, it is a truism to say the market is bifurcated. It always is. However, this phenomenon is more extreme now than at any time in my rather too long career at this point, and it's making the courting process more important than ever before. Secondly, we are living through an adjustment phase in returns. After a very good run, the mix of high entry evaluations during the COVID years and a soft macro afterwards is catching up with the industry. And this is being reflected in return erosion for COVID-era vintage funds. Dangerously, we will, in this segment, make some predictions about where we think those years will come out. Watch this space. Thirdly, and related, we're in a period of change. As returns compress, LPs are looking for new relationships that they believe will perform better in the years ahead. This is, of course, exciting, but there will be a number of casualties along the way. Fourthly, linked to the general lack of certainty we all feel, diversification is back on the agenda, and particularly geographic diversification. And it is true that we are seeing investors look more towards Europe and even Asia with greater attention than before. Fifthly, for a variety of reasons, somewhat hastened by the softer liquidity environment we're in, CVs have become truly mainstream, with broad-based market acceptance and widespread education. However, with an increase in utilization comes an increase in scrutiny, and GPs need to be careful when considering such transactions. Regarding impact strategies, our short take is that the hype that surrounded the segment over the last few years is now at an end. The narrative has shifted and the froth has gone. However, the baseload allocations and interest in the segment is meaningfully higher than it was when we started, and we would caution against knee-jerk reactions. And finally, the retail revolution is clearly upon us. The funding sources for many of the storied names in private markets is changing fast. This is going to have a profound impact on the industry in the longer term, which we know is causing some consternation. However, we think there is room for optimism for where it will all ultimately land for the industry.
Thanks, Adam. So fast or slow? Private equity fundraisers in today's markets are either very fast, like an ice luger at 95 miles an hour, or slow, like a cross-country skier at 15 miles per hour. This is always true, but the data is telling us that the contrast is even more extreme in today's environment. As you can see in the chart on the left, the vast majority of private equity fundraisers fall squarely into the slow category. Much like cross-country skiers, GPs feel as though they are expending tremendous effort while only inching slowly forward across flat terrain. Over the past 3 years, the average fundraise timeline has stretched significantly, from 19 months to roughly 27 months, adding almost a full year to the journey. To reach their targets, GPs aren't just staying on the trail longer, they're actually having to pull every lever available to them, requesting extensions, creating incentives such as co-invest, and even seeding new funds with high-quality assets just to maintain momentum. In very stark contrast stand the select few darling managers, the GPs who command such extraordinary demand that they can dictate timelines, set terms, and turn away less appealing LPs. Remarkably, our own data shows this gap is widening in 2025, with the fast raises getting even faster. Indeed, Rede's 5 fastest fundraises in 2025 rocketed to the finish line with the velocity of an Olympic ice luge, wrapping up in an average of just 4 months. That's down from 13 months the year prior. Now, a major driver of this dynamic is simply how existing LPs act. Their decision to re-up and the timing of that decision is one of the best predictors of how long a fundraise will last. When you have strong support locked in at first close, the whole psychology of a fundraise changes. Since the back half of 2023, the data has been pretty clear. LPs are showing more interest in finding the next best thing versus staying blindly loyal to their past decisions. This shouldn't be too surprising. Many GPs have evolved dramatically over the last decade, and LPs are focused on making the best investments they can for the decades plus ahead. Let's just hope Chris Martin doesn't call them out on it. Now, as a result, 2 very different realities exist on the fundraising trail. And much like Alphaba and Glinda, these realities are dictated by market perceptions. For the fortunate few, call it, 3% of all private equity fundraisers, fundraising is almost a foregone conclusion, and the capital raise moves at exceptional speed. Like Glinda, these managers are popular, confident, and usually armed with strong data and proof points. As a result, they tend to be in market for fewer than 6 months and require far fewer meetings to convert any given LP. For the remaining, say 97% of managers, the experience looks much more like Alphaba's early storyline: overlooked, underestimated, and forced to work significantly harder to prove their worth. These fundraisers require substantially more effort, more time in market, and far more touch points to convert any one LP. Now, every GP hopes that their fundraise will fall into the fast lane category, and why wouldn't they? But reality hits one way or another as GPs and LPs size each other up during the pre-marketing period, otherwise known as the pre-game face-off. On the LP side, the questions are typically, is this GP as strong as they claim? What do other LPs think of this GP, and how will that impact their behavior? And ultimately, do I need to prioritize this underwrite now, or can I wait? Meanwhile, GPs are evaluating their own LP base, assessing loyalty, conviction, who is likely to re-up, and when. This dynamic is one of the reasons we're seeing clients engage Rede earlier in the off-cycle period. GPs want to ensure that they are clear-sighted about where they stand and what needs to be done before the puck drops and the fundraise period begins.
Thanks, Alex. So let's move now from the more abstract vibes of the pre-game face-off to something a little bit more concrete, the latest trends that we're seeing in performance and returns. Now, our usual rule of thumb is that performance starts to be properly measurable around year 4 in a fund's life. And by the 5th year, the final outcome is actually pretty baked in. So we're currently in a very interesting position because for the first time, we're able to look at the vintages from the early COVID period and start to understand whether those vintages are going to be really, really good, like a lot of people initially thought, or really, really bad, like we started to believe after the big cool off at the beginning of 2022, or something in between. And we've done some quite nifty analysis using backdated information from Preqin that allows us to see how average net IRRs tend to evolve over time for different groups of vintage years. The first line you can see here shows us how net IRR has evolved over time when we combine all the funds raised between 2000 and 2020. You can see it's a fairly smooth curve and it rises slowly, and then it pretty much plateaus out after year 5 and stays quite stable, and it ends up around a 15% net IRR on average or median when all is said and done. Now, what about when things go not so well? If we look at the really gnarly GFC vintages from 2006 and 2007, you can see that the curve is the same shape, but everything's taking longer, and ultimately it's plateauing out at a much lower level, more like 9%. So those are rough vintages that start off slow and end poorly. Now, question is, what are we going to see with the COVID vintages from 2019 and 2020? So these funds seem to be following a really different trajectory. Instead of that slow rise, we see a big bump in the first couple of years. Part of that bump is most likely related to the surge in use of subscription line financing that we saw during those vintages, which is designed to speed up IRR in the early years. But it's mainly due to the big write-ups that we saw in 2021, where there was a sort of feeding frenzy taking place. And that was the time that everyone got pretty excited and started predicting that these vintages would be huge winners. Unfortunately, since then, we've seen those IRRs take a real tumble. But the difference in the curve shape from the average makes it quite difficult to predict exactly where they'll end up. So we got to dig a bit deeper into the other metrics to make a good prediction. So let's start with DPI. If we look at all the fund vintages from 2000 to 2020, by their 5th year, the average amount returned to investors is 38% of the total paid-in capital. Then the worst vintages of that period, the ones from the GFC, at their 5-year mark, they were well off the pace. So their average DPI was just 25% of paid-in capital. So what's happening with the COVID vintages that are hitting their 5th year now? Well, they're somewhere in the middle of the two, and their average DPI is 0.3x. Which is 21% lower than the average fund from the broader group of vintages. So that early promise does not seem to have translated into quality exits yet. Meanwhile, within the unrealized portfolios, the COVID funds are actually well above what we saw in the GFC vintages in year 5, and even 10% higher than the average 5-year-old fund from the broader vintage group. That might sound like good news, but there's a real question here about how fair those valuations actually are. And the delayed liquidity that we saw in the DPI chart is really starting to bite. So you can see here that median holding periods have hit record highs. It's taking longer than ever for funds to sell their assets, and that's naturally leading to IRRs taking a real hit. Now, obviously, we can cancel out that IRR hit if we're compensated by big home run exit valuations. But what we've actually seen in the last couple of years, as you can see on the right hand of the slide, is that there are fewer and fewer big valuation pops at exit. And in fact, the exit values are much more baked into carrying values. And unlike this snowboard that you can see here, there's significantly less uplift at the moment of exit than we were having before. So if we take all of this together, it is our view that the 2019 and 2020 vintages are actually converging towards a level somewhere between the GFC funds and that 20-year average. There's obviously lots of margin for error here, but we're gonna stick our necks out and predict that the median return for those vintages is likely to end up somewhere between 10 and 12%. And look, that's going to have some real consequences that we'll need to face up to across the whole industry. And what's particularly difficult is this psychological adjustment that's needed. So with the GFC vintages, everyone had pretty much accepted that those funds were going to be poor performers, and then they just tried to sort of learn lessons and move on. But for these vintages, we started off super optimistic. And actually, if you were around for the Read View webinar in 2022, you might recall our memorable line, 5x is the new 3x. The sort of slow motion come down that we've seen has been quite hard to accept, but now is the time that GPs and LPs are really starting to grapple with that cognitive dissonance and start to make some hard decisions. So the most pressing concern and hard decision that GPs need to take is what to do about the DPI lag. We've got ourselves into a situation where we've had high expectations for the vintages out the gates. They haven't quite yet materialized yet into strong exit momentum. And now we've got richly valued assets sitting in the funds, getting progressively bigger and older, and also potentially harder to shift at those big valuations. On the other hand, as Adam mentioned earlier, the exit environment might not be booming, but it's definitely improved a bit. So the big dilemma for GPs is what to do with these assets. Should they keep hanging on for an exit in the future that matches the unrealized marks and will help get their fund into the upper quartiles in the end? Or should they swallow their pride, cash their chips in now, and provide their LPs with immediate liquidity and more certainty? It's a tough decision, but we often say to our clients, nobody can foresee a black swan event, but we can definitely say that no matter how black the swan, it can't tank a deal that you've already exited. So ultimately, our prediction for 2026 is that GPs will increasingly go for the immediate liquidity option. But the flip side of this is a lot of those exits won't be stellar. And our LPs are telling us they expect the same thing. So in our recent RLI survey, 54% of LPs said that they do expect to see an uptick in distributions during 2026. And if you're a GP wondering which way to go, you might want to think back to that chart Adam showed you earlier with the terrifying monster Vecna that was looming over it. When we asked LPs what their biggest concerns were for the year ahead, 71% of them cited slow pace of exits as a major worry, completely dwarfing all the other quite legitimate fears. So ultimately, if you're a GP wanting to improve your standing with investors, exiting what you can right now and accelerating your distribution pace has got to look pretty attractive right now. So look, for the majority of GPs, we are expecting to see that shift in behavior. But there's a small group of GPs where that's less likely to be the case. In our last Read View presentation, we said that we're in a phase of creative destruction within the market, and that is more true than ever. For some managers, the difficult environment of the past few years means going out fundraising just isn't really an option right now. And that means they're at high risk of turning into the dreaded zombie fund. If that is a potential outcome for you, it really changes the maths on the exit calculus. If you're not sure you can raise a new fund, you're reliant on management fees from older ones, and selling assets actually reduces the fee calculation basis that you're surviving on. Plus, if you're less sure of your ability to secure new capital, you're probably more incentivized to keep hanging on and hold out for a big carry event, even if it takes a long time. But GPs should be aware that giving into that urge is likely to create a bit of a vicious cycle and potentially even hasten their descent into zombie land.
Thank you, Gabby. So against the backdrop of the market dynamics that Gabby's just outlined, it's perhaps unsurprising that we're seeing increased LP appetite for the new and exciting, so long as it's not too unconventional. If we start with where LPs are actually increasing allocations, what really stands out is the focus on the smaller end of the market. As you can see here, lower mid-market and mid-market buyouts are dominating LP interest as the large cap segment faces pressure from elevated entry valuations and slower exit activity. We're also seeing the impact of many managers who built their early success in the lower end of the market, but have since scaled up, creating white space below them. By contrast, the smaller end of the market benefits from more reasonable entry multiples, greater scope for value creation, and importantly, a broader set of exit options, which is driving LP appetite for exposure here. An appeal for the new remains strong. It's clear that there's real LP appetite to refresh portfolios as more challenging market environments have forced LPs to reassess their existing GP relationships and ensure they're backing managers that are positioned to perform better in the years ahead. Over 40% of LPs expect to deploy capital to new relationships, and nearly 30% are planning to allocate to a first-time or emerging manager, with newer managers often benefiting from a cleaner starting point without the overhang of earlier portfolio vintages. So when LPs do decide to bring on a new relationship, what does that actually take to displace an incumbent? As Alex mentioned earlier, we did have notable standout fundraisings over 2025. And it's worth spending a moment on what were the features that really drove the success of those fastest raises. First and foremost, strong performance, with these managers on average demonstrating close to a 4x realized return multiple. Secondly, it's about having the right organizational setup and capabilities to deliver these results consistently. Here we show an average value creation team size of 10, but that edge shows up in other areas as well, be it a differentiated sourcing model, clearly defined AI capabilities, or a systematic approach to how the GP is driving liquidity within their portfolio. In addition, strong alignments of interest and a clearly defined specialization, whether by sector or investment approach, were also key success factors. When we look at first-time funds, we see two distinct paths to success. On the left are what we call the darlings. Think of these a bit like the must-have toys of the moment, the boo-boo dolls. They're instantly recognizable, in high demand, and people feel comfortable buying into the story quickly. These are typically spin-outs from GPs with a clear halo effect, bringing strong individual track records and strategies that align closely with their prior experience, often with a degree of refinement rather than reinvention. On the right are the tenacious. These are often true first-time teams, building something new brick by brick. They typically need more time, more proof points, and more creative LP engagement, but they can be just as successful over the long term. What unites both of these paths is that LPs aren't just underwriting past track records, they're also underwriting how managers are positioned to generate outperformance in today's market environment. And that brings us to AI. AI is clearly emerging as a major change agent across industries. The potential for efficiency gains is extraordinary. Indeed, I'm sure we can all point to real examples of these sorts of gains we're seeing in our day-to-day. This presents an enormous opportunity for private markets managers, given their ability to make nimble decisions, put capital to work in segments that stand to be beneficiaries, and drive true transformation. At the same time, there's a great deal of uncertainty around who the ultimate winners will be. Disruption inevitably creates both winners and losers, and we've seen that uncertainty play out most visibly in the recent sell-off across parts of the tech sector. Much of that reaction reflects concerns about what could be disrupted, rather than clear visibility into what is being disrupted. Against that backdrop, having a credible AI strategy is rapidly becoming absolute table stakes for private markets managers, regardless of sector. LPs are not expecting all the answers, but they do expect a clear plan for how AI is being incorporated across the organization into decision-making, sourcing, and value creation. And importantly, this elevates the value of things that cannot be disrupted by AI, specialist judgment, sector expertise, and trusted relationships, which remain critical differentiators for successful managers and will be even more so going forward. So while investors are increasingly open to the new, we're also seeing a shift in where capital is being allocated. With return compression in private equity and appreciation in private credit, we've seen capital begin to shift to more credit-like strategies. We predicted this dynamic 5 years ago, and it's very much playing out today, particularly through increased appetite for some of the higher returning areas of private credit shown here. At the same time, and picking up on Gabby's earlier point, longer exit timelines and lower levels of DPI in private equity are sharpening LP focus on liquidity, which is further supporting interest in credit-oriented strategies. So in a world where people are looking for new things, it is also noticeable that investors are looking at new markets and rethinking geographic concentration. For the first time in a long time, that means actively looking beyond the US. However, if you look at the underlying economic data, that shift in focus isn't really driven by growth fundamentals. Despite some quarter-to-quarter volatility, US growth has continued to outpace Europe over the past year. By contrast, capital flows are telling a different story. Over 2025, RLI data shows a flattening in inbound LP demand for North American GPs after a long period of outsized interest. This suggests LPs are taking a more balanced approach to deploying capital in North America. Europe, meanwhile, has moved firmly into the expansion zone. The RLI data is reinforced anecdotally by LP conversations we're having, where we're seeing a clear appetite to add new relationships across the region. Asia Pacific has seen a meaningful pickup in attention after an extended period out of favour, and that reflects improving private market opportunities across several countries in the region in the wake of the move away from China-centric allocations. So what's actually driving this shift? First, some of the political uncertainty that Adam referenced earlier, driven by US policy moves, rising geopolitical tension, and broader questions around a changing world order. Second, currency. For much of the last 15 years, US-based investors have faced persistent FX headwinds when investing in Europe, which naturally dampened appetite. That dynamic has eased, and FX is no longer seen as a structural drag on returns in the same way. Third, there's a clear catch-up effect. Regions that were out of focus for an extended period are beginning to attract capital again as portfolios are rebalanced. So importantly, this shift isn't being driven by a dramatic change in underlying economic fundamentals, nor is it a wholesale vote of confidence in European growth. Rather, it reflects a desire to achieve greater geographic balance within portfolios rather than a binary bet on any single region. So the key takeaway from these last few slides is that interest in specific segments can be fickle, volatile, and change quickly. In that environment, it's critical for GPs to not be overexposed to any single LP cohort, and instead to future-proof their investor base and build resilience as appetite patterns shift. This slide shows where we've raised capital over 2025. It's not intended as an advert for Rede, but rather to illustrate a broader point. This is a truly global capital market, and building a geographically diversified LP base is one of the most effective ways to provide resilience over time.
Thanks, Ian. Well, it wouldn't be the Rede view without talking a bit about the latest trends in fund management techniques. And this year we wanted to highlight some of the important changes we've seen emerging in the world of continuation vehicles. Since our first RedeConnect in 2021, continuation vehicles have gone from a bit of a cult interest to really hitting the big time. Our friends at HarbourVest recently published some data that perfectly highlights this. They estimated that last year, CVs accounted for 19% of sponsor exits, which is almost 4 times higher than in 2020. And that's honestly no surprise because there are really strong incentives for managers to do CVs. So as more and more GPs learn about the benefits, it's natural to see a fairly unconstrained growth in demand from the GP side to launch these vehicles. The constraints are likely to come more from other stakeholders, and we'll explore how that's starting to make itself seen over the next few slides. Now, it's sometimes hard to remember that continuation vehicles were originally often called restructurings, and for a long time they were viewed as a bit of a badge of shame for poorly performing funds that needed more time and money to get to the finish line. That all changed with the emergence of one of the most important trends of the last decade that we've spoken about time and time again, which is GP specialization. As GPs became more highly skilled and specialized, they were increasingly viewed as the natural owners of relevant assets, which meant that investors were increasingly willing to back them to keep driving value within those assets for longer. Then, as the exit squeeze kicked in, we started to see GPs using CVs, continuation vehicles, as an active fund management tool to optimize liquidity to investors. And now, as the first crop of CVs are reaching the end of their lives, it seems like we're about to witness an explosion of more sophisticated approaches to CV technology, and we're referring to that here as CV 2.0. So this evolution wouldn't have been possible without some important changes in the universe of buyers that are committing to these vehicles. And you can see that on the bottom half of this slide. Historically, there was a real supply-demand imbalance here. There were more GPs wanting to do continuation vehicles than there were investors who could commit to them. Most of the investors in those vehicles a decade ago were generalist secondaries funds, and they were diverting a little fraction of their funds away from more vanilla secondary stake purchases with not much room to maneuver or be creative. Then we started to see some more specialist secondary funds emerging that focused specifically on GP-led transactions, and that definitely helped. And then they were joined by some of the larger, more sophisticated generalist LPs who joined the party, often as part of their co-invest program. And then most recently, we've had a major new development where big brand name GPs are increasingly raising dedicated GP-led funds that sit alongside their other strategies across their platform. So if you dive a bit deeper, you can see how things have evolved in the market and sort of why. The real take-home message here is that the universe of GPs and assets that are participating in the CV market has broadened considerably. Smaller GPs, more complex underlying assets, more complex situations. And that's led to a need for much more sophisticated behavior from the buyer side, with more nuanced approaches to underwriting and also negotiation. And it's that quiet revolution we just discussed within the buyer universe that has supported the expansion of the market. The new tribes of buyers we just talked about, they're the ones who are able to underwrite more complex, more disruptive investment theses. And that has implications for pricing, which has become less sort of mechanistic and NAV based and more fundamentals based. And it also has implications for the complexity of solutions they're able to commit to and the universe of changes and improvements that are possible within the market. So with that increasing sophistication, we're starting to see early signs of what the future for CVs might look like. It's a sort of whole suite of variations on the theme. We've picked out 3 notable trends here, but this could easily be a whole webinar on its own. Maybe watch the space for next year. Very, very quickly then, CV squared vehicles, they're continuations of continuation vehicles. And you might think that sounds like a kind of a failure of the original investment case. But if you're thinking in terms of that concept of the natural owner of an asset, it can actually make a lot of sense so long as the economics are right and fair. And quite similar to that, we've got the reinvestment vehicle, RIV, that we call it. That's where a GP is exiting an asset, usually to another manager, and they want to keep a slice of it alongside the new owner. They put that slice into a dedicated vehicle that's its own continuation fund. And finally, we've seen some GPs, pretty small number, but notable, take the concept of the CV and turn it into something more substantive and institutionalized, which is sometimes called the Legends Fund. That's where they establish a fully fledged new fund series that will systematically take star assets forward to a longer hold and like a consolidation phase over time. It can be a game changer for GP franchises because it adds a new long-term stream of fees and carry. But look, it's definitely not for everyone, and you do need to navigate some complexities around particularly what the presence of that legend fund means for the assets you don't put into it. Now, meanwhile, as CVs have become more mainstream, they're inevitably attracting a lot more scrutiny. And for a long time, we were kind of able to brush that off as chatter, sort of ill-informed sniping. But over the last year, we've started to see some pretty heavyweight industry participants raising the alarm about certain aspects of the CV market. And that's culminated in the recent pretty well-publicized legal action that was taken by ADIC against one of their GPs that was seeking to execute a continuation vehicle they disagreed with. Our own anecdotal data also shows that over the last year, LPs are taking a much tougher look at CVs their managers propose. And increasingly, we're seeing them accept the liquidity option rather than participate in the CV, which is really quite a red flag in itself. So look, despite all that doom and gloom, it's our view that rumors of the CV's demise are much exaggerated. there's a reason why these vehicles have developed and caught on and been as popular as they are, and that is going nowhere. But if you're going to attempt a CV in this environment, you will need to take LP concerns seriously. And you'll need to present a genuinely well-reasoned rationale explaining why this course of action is beneficial to all the stakeholders. You need to be transparent and proactive in managing potential and particularly perceived conflicts of interest, and ideally build in some kind of robust third-party price level setting as part of your transaction process. And ultimately, look, you're much more likely to pull this off if you're a very well-respected GP and if your CV is focused on a super high-quality asset or group of assets that are in an LP-friendly sector. Now, the problem with this is that if we only put the best assets from the most in-demand GPs into continuation vehicles, it sort of negates the whole original reason the industry started doing these transactions in the first place, which was to help struggling funds achieve better outcomes by giving them more time and money, and importantly, re-incentivizing the team. If that avenue is shut off, we've got to start worrying all over again about the zombie invasion I mentioned earlier. And it's potentially a very big zombie invasion, even bigger than we'd imagined a few years ago. We're currently sitting on over $800 billion worth of NAV from funds whose initial terms have technically expired. That is around the same size as the GDP of Taiwan. So given everything we've heard so far about the lengthening hold periods, the performance struggles, the sluggish fundraising market, that is a lot of assets that could easily get caught in a zombie apocalypse if the CVs are no longer a sort of escape route for them. And if we can't use CVs as a magic bullet anymore, we're going to have to find some more creative ways to de-zombify those struggling funds.
Thank you, Gabby. Moving on from zombies, but turning to another theme that is close to retail. The last few years have seen dramatic increases in the volume of capital raised for sustainability and impact-related strategies. However, there is no doubt that there has been a changing mood here. So let's start by addressing the elephant in the room. Clearly, the inauguration of Donald Trump has significantly changed the prevailing sentiment. That's obvious on a policy level, where there's been a change in direction away from what you might call climate positive policies of the Biden administration towards something very different, which has impacted various segments on the ground in the US. But probably more importantly, on a global level, beyond the specific policies, it's hard not to argue that the zeitgeist has changed, to use a technical term. How best would you summarize that? Well, good for the sake of it is out. Indeed, if you look into some of these quotes, even the word impact itself is being retired in some quarters, and we are certainly seeing ESG pages in pitch books being shuffled further and further back as time passes. So does that mean the end for sustainability-oriented strategies? Well, I think a quick trip down memory lane is helpful here just for some context. The slide shows the ups and downs of sentiment towards sustainability-oriented strategies over the years. And no, this is not particularly statistically proven information, just a bit more anecdotal. From the rise and fall of clean tech around the GFC to the slow growth of megatrend-oriented investment strategies in the 2010s, to the more recent COVID-induced impact wave, and now the current pushback. What we have seen throughout this period is plenty of ups and downs. I think our caution here would be that while sentiment can be ephemeral and prone to fads, big global challenges are not. And as we look forward, it isn't hard to imagine what can swing the pendulum back. Dramatic climate events have a habit of reminding us of the challenges that we need to solve. And who knows which is the next one round the corner. The social consequences of new technologies such as AI are potentially perilous, as we all know, and may require us to rethink about how we organize our economies and societies. And ultimately, of course, political winds change, and with it, different narratives emerge. So our general view would be to caution against any knee-jerk reaction to short-term sentiment. So much for the future. What about the here and now for sustainability-oriented managers? Firstly, you need to perform. The growth of the segment over the last 5 years has very much been driven by investors who saw a full alignment between achieving certain global objectives and performance. They will not be that forgiving if you let them down. Secondly, there was once a concept of a green premium. This is the idea that people will pay more for something because it achieves a broader societal objective or climate objective. I think we can agree that that feels somewhat anachronistic today. Rather, successful strategies will tend to root their approach in what we've described here as a green discount. For example, how more sustainable use of resources can offer solutions both better for the planet and cheaper. Renewables are a great example of this, and rooting your strategy in cold, hard economics has never been more important. And finally, linked to this, as we have said a few times, we live in an unstable world. Sustainability-oriented strategies are ultimately about delivering a society that is more resilient, whether that be in the use of resources, supply chains, how we protect our critical infrastructure, or indeed manage our society. Strategies framed in this way will have the best chance of convincing LPs who, as the stat suggests, are worried about how they protect their portfolios given the uncertain world in which we live.
Thanks, Adam. So one of the most frequently discussed topics in private markets today is the growing opportunity for GPs to tap into retail capital. This momentum is driven by a few converging market dynamics. Number one, retail allocation growth expectations. A few years ago, several industry forecasters projected that retail allocations to private equity would grow roughly 50% faster than institutional allocations over the next decade. As you can imagine, this immediately captured the industry's attention. Number two, the reduced cost and complexity to establish an evergreen structure. It quickly became evident that retail investors overwhelmingly prefer evergreen structures to traditional closed-end private equity funds. This preference sparked the development of an entirely new ecosystem of platforms, administrators, and distributors focused on making private equity more liquid and more accessible. Over time, these innovations have meaningfully reduced the cost and complexity for GPs to launch their own evergreen vehicles. And number three, the rapid rise of continuation vehicles. These investments are inherently more liquid than traditional blind pool funds. Additionally, they don't suffer the same J-curve and cash drag dynamics. As such, these vehicles have emerged as sort of the perfect tool to help structure evergreen funds with enough liquidity to meet terms. It's worth noting that co-invests and seeded funds also play a role here, serving as an additional source for more liquid exposure. All of these forces have fueled dramatic growth in private equity evergreen vehicles over the past decade. And based on the volume of inbound inquiries we are receiving here at Rede, we certainly expect this momentum to continue for the foreseeable future. Indeed, Hamilton Lane projects that evergreen vehicles, currently about 5% of total private markets AUM, will grow to at least 20% over the next decade as adoption accelerates. All of this suggests that we are still in the very early innings of this evergreen expansion. Now, while this retail opportunity is undeniably exciting, it has made many institutional investors increasingly uneasy. So much so that ILPA recently released a white paper outlining their core concerns. These concerns fell into three main categories. Number one, alignment risk. Institutional LPs worry about misalignment, particularly around return expectations and the time horizon required to achieve them. They also question whether investment discipline erode as hard caps become. Number two, competition for historically fee-free co-invest. Retail vehicles typically pay higher fees and can deploy in large at-the-ready chunks, making them an attractive solution to GPs in need of additional equity for a deal. As a result, institutional LPs fear shrinking access to the fee-free co-invest they've come to enjoy. And number 3, governance and operational complexity. Institutional LPs worry that the retail channel erodes the current fund governance structure, given it introduces a new board of directors, which has fiduciary duty only to the retail LPs. Additionally, it comes with increased complexity when it comes to tracking fees and expenses. These themes are central to LP-GP conversations today and are increasingly playing a role in fundraising dynamics. So what does this mean? In our view, these dynamics are forcing GPs to pick a lane that will deliver their future. Firms must decide whether to embrace retail capital as a pathway to optimize their business or double down on achieving alpha with the support of patient institutional capital. The industry is already showing clear examples of both paths. On the one hand, we have seen GPs publicly highlight their intentions to embrace the retail channel, in some cases, even putting institutional LPs on watch that they should expect to pay some fees to access co-invest opportunities going forward. On the other hand, we've seen GPs reiterate their firm's identity as alpha-oriented and emphasize the expectation of holding investments for their typical 4 to 6 year period to achieve this. This implicitly acknowledges that achieving the level of alpha these managers desire is incompatible with the liquidity needs of evergreen retail products. As a result of these dynamics, we envisage the industry's embrace of the private equity yield curve. Most investors are well versed in the concept of a yield curve, whether it's in infrastructure, real assets, fixed income. These yield curves illustrate the relationship between expected return and time or maturity. We believe that the accelerating influx of retail capital will reshape private equity enough to create the need for a private equity yield curve. This curve would more clearly distinguish between GPs delivering accessible, diversified beta returns structured for scale, liquidity, and broad distribution, and on the other side, alpha-oriented GPs, those pursuing superior performance in the traditional sense with the support of patient institutional capital. In short, we expect this concept to take hold as a way for the market to more clearly articulate the delineation between GP approaches.
Thanks, Alex. So coming into a close, just about on time here, let me summarize the key points of our presentation and our predictions for the coming year. The bifurcation of fundraising speed will continue, and which lane you'll be able to achieve as a GP between fast or slow depends on a sharp reading of several factors, both hard and soft, and the careful curating of a credible market buzz. We'll all still be coming to terms with returns that are trending lower from their COVID-era valuations amid a squeeze on liquidity, not to mention a return of the zombies. There will continue to be a strong bid for the new and exciting, whether the darlings or the tenacious, and AI will become table stakes. We'll count on our industry to apply it as a positive change agent as we see more emphasis on risk and liquidity, which, along with return compression, could bode well for private credit and infrastructure. Diversification is back at a time when the US is less the default choice as partner, and the things out of our control are presenting more and more risk. The application of GP-led secondaries technology will continue to proliferate so long as conflicts are managed and solutions perceived to be win-win. And it'll continue to push boundaries beyond CVs. While the changing political landscape may impede climate and impact as a label, the themes being addressed are still very real. The megatrends remain. We need ever more power. The energy transition is imperative, and there will continue to be strong demand for proven strategies based on hard returns. And finally, retail is reshaping the market in ways that will benefit a large cohort of asset managers, but will require GPs to pick a lane as to which constituents they really want to serve and rely on longer term. There we go, folks, right on time. So let's turn to questions now. I see several of them have been coming in. How about this one Firms have been, from an anonymous participant, firms have been talking a long time about more operational focus. But how do you expect that to come through? Is it more headcount, focus on cross-portfolio initiatives, et cetera? Adam, would you like to take that one?
Happy to, Scott. I think the points that were made in that in the question are key. I think that the what we're seeing be most important in the way that investors are thinking about, like, the winning managers of today are managers that back up whatever strategy they have with organizational design in the form of systems, whether that be process systems or human systems, to deliver specifically whatever it is their strategy pertains to. So that can be different depending on different managers, and clearly specialists and stylistic specialists versus sector specialists will have different need for resources. But I think you're seeing more and more developing there. Clearly, investing in talent is an important element of that. I think, as it's obvious to say, but with AI developing, we think AI and data analysis is another key part of that that's particularly relevant to certain strategies. And then I think it's also about playbooks, about having, I think we ascribe to the view that people tend to do things best if they repeat them over and over again, and people refining their go-to-market approaches from an operational perspective and tying that to real practical achievements is going to be what you're seeing more and more of in the year ahead.
Great, thanks, Adam. Here's another one that came in from an anonymous participant. Can you tell me more about AI? What parts of the typical PE house are going to be made obsolete by AI? Let's go to Gabby for that.
Yeah, good question. It's interesting. Obviously, Ian covered quite a lot about how AI is, affecting the investment, the actual investment choices, and the investment opportunities. But we're also, hearing an awful lot on the fundraising trail about how GPs are leveraging AI to improve their own internal machine. And there's a few things going on. What I would say is it's very much looks like it's a kind of a stepwise process. So there's low-hanging fruit, and then there's a bit more kind of, the bigger dream, which is definitely not yet a reality. So I think the most obvious thing that is already starting to emerge is the automation of elements of, like, initial diligence and investment memo preparation, using some of the generative AI tools that can scrape various data sources and put together competitive analysis and identify sort of weaknesses in businesses and stuff like that. And that obviously reduces some of the firepower that you need in on the junior bench to do that research and put together those documents. So that is already, I think, starting to make a bit of an impact on the way that GPs are going to be thinking about resourcing their teams. On the sourcing side, that was probably the area where we first heard a lot of noise about AI. What I would say on the sourcing side is that AI is replacing some of the more manual and sort of less systematic processes of putting together market maps and target lists and checking who's been followed up and things like that. It allows you to automate the sort of process of managing sourcing. It also allows you to be sort of more sort of comprehensive in your sourcing, and make sure that you cover a greater percentage of your sort of target universe. But what it definitely doesn't do is prevent you having to be really personal in the way that you actually approach companies or interact with them. And in fact, what we are seeing is that GPs need to be even more personalized, even more specific in the way that they're approaching and talking to potential portfolio companies, potential targets, because those targets are being bombarded with all these automated AI emails all the time. So they actually need to work harder on personalizing the approach. And it's definitely not reducing the firepower that they need on the sourcing side. And then finally, on the fund management side, we're sort of starting to see some developments in sort of streamlining reporting processes. I think sort of EQT was one of the first groups that really pushed to do that. And obviously, the bigger the GP, the more portfolio companies, the more funds, the more LPs, the more value there is in improving and automating that data sort of collation process. But in smaller GPs, there's a bit of a question about whether it really moves the needle when it comes to value. So those are sort of the process areas. And then I think ultimately where the rubber really hits the road is in the use of actual internal data that is unique to you. So how you collect your data, how you manipulate it, and how you draw insights from it. And one area where I think we're expecting to start to see the fruits of this earlier than others is potentially in areas of specialist private credit, because in those areas you can have much more line items of potential transactions and completed transactions that are quite similar to each other. So that gives you, this idea of, is your data big enough to do big data analysis on? They have enough sort of line items of similar transactions that they can start to get some really interesting insights. So we are starting to see that emerge amongst particularly specialist credit managers, where it's going to help them triage deals, price deals, underwrite deals, and also like identify early warning signs in portfolio management, which I think is super interesting. And I would expect that to then start to kind of diversify out towards the private equity and other areas of private markets over time.
Thanks, Gabby. A couple have come in on the subject of retail. I'm going to wrap two of them together, actually, and maybe pose this to you, Adam. The first is, how are you advising your lower mid-market or mid-market clients with respect to considering evergreen and retail client access? We've talked about it's more obvious for the big boys. It seems the early race will be won by the mega brands that have assembled armies and resources to explore those channels. And then related, do you see a world in which retail investors get access to small niche outperforming GPs? How would that happen?
Thanks, Scott. I guess first thing, we always need to be careful when we talk about democratization of access to private markets if you're thinking about families and retail, because there are very different parts of the ecosystem: family offices, ultra high net worth, mass affluent, and retail. And I think for the higher points on that of that ecosystem, on the family offices, ultra high net worth, you do see a lot of appetite and interest in low mid market strategies that it's often directly to the managers, and so that has been a growing theme, I think, across the globe, Europe, US, and Asia. I think on the specifically on the evergreen and the retail channel, it is indeed really the preserve of the larger groups, and that is at least in terms of direct distribution, and that's because the game in evergreen and in retail is about distribution, and you either need to have enough people to be able to distribute yourself, which is expensive and probably larger than most of the whole size of the teams or these GPs in terms of team, or you need to have a brand that you can distribute through one of the big box providers, private banks, etc., that can distribute for you, and that's obviously harder for the smaller groups. I think one of the trends that we've seen, and this probably does link together those 2 points, is that does tend to lead, that does tend to mean that it's the larger groups that are getting that capital. But one of the groups or parts of our ecosystem that we think has seen a resurgence, if they're on the winning side of this, is the intermediary community. So there were periods where people were questioning fund of funds and whether they would stay in business. Was it a succeeding business model? And I think that has evolved somewhat, particularly due to the growth of evergreen retail, because that is the conduit through which quite a lot of that capital is getting funneled. It's not surprising. Those are very diversified pools. They're often very storied, successful long-term organizations in their own right. And those groups are better positioned, I think, to offer bespoke products that are touching different parts of the market. And that is likely where you will see more appetite and interest indirectly from the evergreen retail channel through to lower mid-market and mid-market. And we certainly do see products being developed with that in mind, rather than just the more traditional large mega caps.
Thanks, Adam. One that's come in on the topic of investor preferences, asking us to expand a bit, and maybe I'll direct this to you, Alex. Do you otherwise have views on sectors or strategies that are more in demand than others in the short term?
Yeah, happy to take that. Great question. So I guess there's two ways to think about this. I think the first is sort of size and sort of segment of market. I mean, undeniably, we are seeing LPs have the most interest in sort of the lower end of the market, lower middle market. Just as the perception is the ability to drive and generate higher returns there is more available. So I'd say that as sort of the first piece. The second piece, as we think about sectors, we talked about sort of healthcare, software, industrials. And what I would say is within those segments, there are absolutely sort of subspecialties or capabilities that are driving the most interest. So, for example, in healthcare, the areas that we're seeing probably be the most interesting to LPs right now are sort of one, AI, automation, tech efficiency across healthcare. Number two, anything that can shift lower cost of care or things like value-based care. And then number three, pharma services and biopharma innovation. In this space, we do continue to see provider platform consolidation under scrutiny, which is actually, interestingly, creating some evolutions in that segment where the fragmentation remains. And then sort of finally, as ever, LPs remain wary of anything with regulatory or reimbursement risk. In software, SaaS, vertical software have been high conviction categories for a long time. But as we've noted during this presentation, what we are seeing is just very intense scrutiny around AI disruption for sort of the beautiful software business models that we've come accustomed to. Clearly there's been some noise in the public markets, and certainly we're seeing that not necessarily in valuations, but certainly in diligence. And then I guess finally in industrials, I'd say sort of like two smaller trends emerging. The first is sort of how well equipped GPs are to utilize AI to transform real economy businesses. And then the second, which sort of we called out as its own category earlier, is aerospace and defense. This has been a popular sort of segment in North America for a while. There's been some excellent deals done, great proof points, et cetera. But I would say, as global instability rises, sort of global rearmament cycles are taking shape, we are seeing that interest migrate or evolve to include European aerospace and defense in particular.
Definitely. Thank you, Alex. Maybe picking up on the software point, here's an interesting one that came in. Maybe I'll steer this to you, Ian. Could what is happening in the listed markets in tech, and especially software companies, with the recent sharp drop in valuations, be the first black swan event of 2026, and that might further delay exits, at least in this sector? What do we think?
Yeah, I think it's a good question. I think in our view, it's more of an early warning signal, early stress signal, rather than a true sort of black swan event. Some of the points I mentioned on the AI piece is a lot of this is just around public markets trying to reprice that level of uncertainty around AI and which business models it's going to sort of which business models will benefit versus which business models are going to be disrupted. So you can see it having an impact on certain growth software companies and potential hold periods. But we see this more as being sort of an early stress signal, something that is an early warning signal, particularly around software, as the market tries to understand some of the broader implications as opposed to a black swan event.
Super, thank you. And there's so many good questions coming in. Those of you that have identified yourself, we'll try to get back to you actually. But I think that's all the time we have. So hope this was informative for you. Thanks so much for joining us here today and for engaging with the RedeConnect program more broadly. We hope you enjoy the rest of our programming. Thanks and goodbye.